Welcome everybody to another edition of the CBAR webinar series. My name is Andreas Park. I'm a professor at the University of Toronto in Canada. Just for some background for those of you who are not here regularly, the CBAR is a community of mostly economists, but also people from finance and other areas of business schools. Some people are from engineering, and we have some people also interested in law. And we're trying to provide a forum for people to exchange ideas about, developments in crypto economics, but also broader in digital finance. Today I'm very happy to have Yesha Yadav here with us. She will be talking about payments and the evolution of stablecoins and CBDCs in the global economy. For some background, Yesha is a professor of law. She's the Associate Dean and the Robert Belton Director of Diversity, Equity, and Community, and the Milton R. Underwood Chair at Vanderbilt University. The paper she's presenting is joint work with Jose Fernandez de Ponte and Amy Devine Kim. Both of them are from PayPal. This paper is on law. So it is, if you want, a little bit outside of the comfort zone of economists, but this is precisely what we're striving for here, is we want to actually all learn from one another and better understand how this world of crypto economics can come about and what challenges we face in it. Just for some background, Yesha has a very long and very interesting CV. She worked as legal counsel with the World Bank. She advised the European Payments Council, also India's Financial Services Law Reform Commission. She's worked with the Atlantic Council's task force, and she won both research and teaching awards. Her research is mostly on international banking and financial regulation. It's also on securities regulation, the law of money and payment systems, on bankruptcy. And as I said, she won multiple prizes for her work. So very excited to have here Yesha. And I'm particularly excited to hear something about the first introduction of digital money, government money in Finland, which you probably will be talking about.
Absolutely.
And so I'm going to leave the floor to you in a minute. Just for some background, we're going to have a session. Yesha will talk for about 30 to 40 minutes. Then we're going to have an open Q&A, and when you can post your questions in the Q&A, you can do this actually concurrently with the talk, just so that you won't forget. And I may then call on you to unmute yourself and ask a question in person. Okay, with that, I'm going to give the floor to Yesha, and we're looking forward to your presentation.
Wonderful. Thank you so very much. Thank you so very much to the forum for this awesome invitation. And of course, thank you to my fellow Scot, Andreas, who is just for that incredibly delightful and wonderful introduction. It really is such a pleasure and a privilege to get to have this opportunity. I'm just incredibly happy to get to be a part of this forum. I've loved being a part of this community over the sort of last a year or so. Certainly enjoyed the many fantastic talks that have come before this one. And so I do want to give you guys a word of warning, given what Andreas has just said. This talk might be a bit of an endogenous shock for you guys. There is not going to be a single equation throughout the entire presentation. You might be lucky to see a single number up there, in fact. So the only regression that you guys are going to see today is going to be me, I think, as we get closer and closer to lunchtime. So I apologize in advance for all the words that are going to be coming your way shortly, but that's the price you guys are going to pay for having a lawyer come and give you a talk today. So I apologize for everything that is coming before, but this is very much a conversation, and I'm super excited to get to have the time at the end to really think through some of the ideas and talk through the discussion surrounding payments and stables today. All right, so I thought I might take us back to happier times, and particularly to the basically the best decade, which was, of course, the 1990s. So I think we can all agree that was the best decade that ever was. And so I thought I might take us back to the early 90s, a reminder for everyone who has missed it. But this was like the big tune well back at that time. If you guys can remember all the way back, this was the big happening tune of the decade. And of course, the movie, the blockbuster of the season, for those of you who had For those of you who missed John Wick, this was John Wick before there was John Wick, the gift that keeps on giving, Speed. So for those of you who haven't caught it, please make sure that you're watching. But of course, the 1990s, 1993, 1994 was famous for another big major reason. This was the year that gave us the world's very first prototype CBDC. And this CBDC was launched in Finland. It came in the form of this Avant card. The Avant card was launched by the Bank of Finland. It had a magnetic stripe, no internet obviously at that time. And this magnetic stripe recorded central bank-backed digital money entitlements, right? This was a card that was containing and recording central bank-backed money entitlements. And it was designed with a very specific purpose in mind, right? The Avant card was a card that was anticipating a future that was generally cashless way back in 1992, 1993, right? This was a card that was supposed to eventually replace all of the notes and coins in circulation in Finland at that time. And what was really kind of interesting about the Avant card was that for a period of time, this was a card that became extremely widely used throughout the Finnish economy, right? So the Avant card was being spent, was being accepted at merchants throughout the country. This was a card that took on a whole bunch of popularity for a decent chunk of time. But obviously, as you guys can, as we all know, there is no Avant card in Finland anymore. There is no CBDC in Finland anymore. And so this card met a pretty dismal fate. The Avant card, over a period of time, basically died a fairly miserable and sad death because it came with one fundamental design flaw. The Avant card was a card that was designed to be reloaded when it ran out of money. So as soon as you spent the balance on the card, you had to reload it at specific ATMs. And the problem was that the reloading process cost money, right? So users had to pay fees every single time they wanted to reload the card. And so, of course, who the hell wants to pay money to pay money? And so this design basically died pretty quickly as users lost interest and didn't want to use it anymore. Merchants stopped accepting it. Network effects died away. And so the point of this, entire, story is just to highlight a very simple fact that we all kind of know and understand, which is that central banks, policymakers, private institutions have been innovating around the format and design of money, using the technology at their disposal for a very, very long time, right? They've been working hard to create new forms of money, harnessing the technology available to them in a way designed to make the money flows in the economy as efficient, cheap, fast, and usable as possible. And so what we're dealing with today in the context of CBDC and stablecoins is really nothing new, right? This is not a particularly novel challenge that is facing regulators, policymakers, us in the room today, right? This has been done and has happened before. Right, but the question that is, before us today is really, what is the state, the current state of the US payment system? How well is it working? And what specific use cases do CBDCs and stables in particular, right, given the specific technology propositions that they represent, right, what particular use cases do these technologies provide that might be able to remedy some of the deficiencies and shortcomings within our payments marketplace? And so perhaps most intriguingly of all, I think for all of us, is thinking through a third question here, which is, what are some of the regulatory fixes, some of the policy ideas that we need to put in place if indeed we want to have stables and CBDCs enter the payments economy? What are some of the policy ideas that we need to include as part of our thinking as academics in order to facilitate that kind of integration? So that is the basic sort of roadmap for today's talk. thinking through first and foremost, what is the state of the current US payment system? How well does it work? What does it do? How is the base mechanism of this payment structure working today? And following this, thinking through the particular contribution, the specific contribution of stablecoins and CBDCs as potential solutions to deal with some of the shortcomings within the current payments environment. And then thirdly, of course, most importantly, given that we're all kind of going to be lawyers today, is thinking through some of these regulatory and policy ideas that might enable stables to come into life in a safe and efficient way throughout the payments economy. So, that is the basic roadmap. Again, just to emphasize, this is very much going to be a conversation. I know that Andreas is keeping a queue, but if you do have questions in the middle, anything that needs clarifying, please do just feel free to let me know. I'm very happy just to talk through ideas as they come up. All right, so Andreas, let me ask you a question before you ask me a question. When was the last time that you used cash?
I can't remember. Not for years.
Amazing. Fabulous, right? That was exactly the response I was hoping for. Couldn't have planted a better response. So, I think for most of us, if we were to de-webinar ourselves, for most of us, I think it would be hard to remember, when we were using cash last on a regular basis, right? For some of us, we may not even have cash being carried in our wallets. And this is something that has obviously become, just anecdotally in our everyday lives, something that has become, much more present and prevalent in the lived experience that we're all kind of having, right? That, we are seeing, particularly post-pandemic, just a lack of need to use physical cash. But this has been borne out, by some of the surveys and evidence that is being produced to document the fact that physical cash today seems to be on its way out. Right, so what we have in the economy today, particularly post-pandemic, right, is a pretty large-scale use of cash in the economy. According to one 2022 survey by Pew, for example, approximately 40% of all Americans generally reported using absolutely zero cash throughout the week to make their weekly purchases. This figure rises to 60% of those who make more than $100,000 a year in income, right? So we're seeing just a kind of self-reported survey, like 40%, 60% of Americans just reporting using no kind of cash whatsoever, exactly like Andreas said. Sort of perhaps more rigorously, right? The Fed, for the very first time in its payment study, documented the fact that for the very first time in its recording history, online payments made remotely exceeded those that were made in person and using sort of card-based payments in person in the store, right? So for the very first time ever, right, the Fed reported the fact that in-person store-based, payments, cash, card, whatever, were being dwindled out of the marketplace and replaced by online remote payments. So what it feels like is happening today, right, is a shift away in our payment structure from using cash and towards digital online means of payments on a regular basis. Now, this dynamic, this kind of structural shift that we're experiencing today comes with three big picture implications that I think are worth keeping in mind as we kind of talk through some of the ideas behind stables and CBDCs, right? So, just to kind of keep these big themes in our back pocket, right? The fact that we're seeing a move away from cash and towards digital payments, right, has three giant implications in my mind, right? First and foremost, we're dealing with a shift in our pocketbook away from using public money and towards using private money claims, right? So what the hell does that mean? I think it takes just, 1 minute, just one tickety-boo of a minute to explain what I mean by that, right? So, we have two types of money claim, public money and private money. Public money, obviously, is money that is backed by the state, comes with the full faith and credit of the state. In the case of physical cash, notes are backed by the Federal Reserve, And in the case of coins, they're backed by the US Treasury, right? But overall, these are instruments that carry exactly zero credit risk unless something has gone horribly wrong. These are claims that come with absolutely no credit risk. By contrast, however, private money, right? Private money is the kind of money that we are kind of used to dealing with when we are talking to our banks, for example, or non-bank payment firms, for example, those that are providing digital wallets, etc. These are private claims for the money that banks and non-banks owe us that we deposit with them. These are private money claims. They come with credit risk. Right? If a bank fails, for example, or if a payment firm fails, for example, we have to stand in line in order to get our money back. Right? So the private money claims are coming with some amount of credit risk. And so what we're seeing in our pocketbooks, what we're seeing in our wallet, right, is a shift away from public money, money with no credit risk whatsoever in the form of physical cash, and towards private money claims, which obviously come with a degree of credit risk imputed into their very design. Right, so according to a Bank of England survey in the UK, for example, as late as 2010, approximately 60% of all purchases were being made using cash. Right, by the time the pandemic came around, 2021, right, that figure had fallen considerably, and approximately 95% of all money that is being spent is being held in the form of private money claims today. So what we're seeing is this changing balance between public money and private money. And just to kind of clarify, the only forms of public money that we, the plebs, right, we, the people, can actually handle is physical cash. So the less we, interact with physical cash, the more we're going to interact with private money claims relative to public money claims. The second big implication that I think all of us in the Zoom room kind of get, because we've been working on this issue for quite a long time, right, is the rise of fintech, right, is the fact that digital innovation within the payments economy, right, has emerged as a function of, non-bank innovators entering the space in a big way. So what we've seen over the last decade and a half, right, is this growth in technological firms that are bringing their tech and their innovation to streamline and make efficient various parts of the payment process. So, for example, with fintech, we have non-banks that are providing, for example, digital wallets, right? We have peer-to-peer payment networks like Cash App, Zelle, that's a bank app, obviously, Cash App, Venmo, and others, right? We have entrants like Amazon, Google Pay, Walmart, right? Try and provide a host of payment services, including cards, digital wallets, etc., to the mass market. So what we're seeing today with fintech is the introduction of a much more heterogeneous cast of characters within the payments economy, right? We're diversifying away from just having banks lead the way in payments and introducing a whole bunch of new kinds of payment providers that are becoming part and parcel of the delivery of payments within our sort of digital payments universe. So we have the shift from public money to private money. And we have issuers of private money today include a whole host of non-banks that are entering the payments economy in a big way. And so obviously, what does this mean for our payment system? Right? What the hell does this mean? This shift from public money to private money for everyday people, for like a new and diverse cast of payment providers, issuers of private money claims, right? What is the risk that is emerging within the payments environment? Does our plumbing within payments withstand this new innovation that is coming towards it? What kind of accommodations do we need to make in order to minimize some of the risks that are developing through the shift from physical cash to digital money that we're seeing in the economy today? So those are some of the kind of big picture themes that I think are worth bearing in mind as we, talk through some of the ideas with CBDCs and stables. All good so far? Awesome. All right. So I think I'm going to do something super horrible. And I apologize in advance for this again, but I'm going to, I think it's worthwhile when we talk about the current state of the US payment system to have a very, very quick primer on how this payment system actually works. Again, masses of apologies. I realize your first inclination when you see this is to check out what the hell is happening in the SBF trial, or to, catch a Prime deal on Amazon or whatever. But it's going to be not too horrible, and I'll try and make it as painless as possible. So we'll do this quick, and then we'll move on. All right. Let's check out a basic payment, right? So in any basic payment, we're dealing with two major steps legally, right? So the first step, obviously, as we know, is kind of making the payment or sending the payment instruction for that payment to start being processed. So we have the first step, which is making the payment happen. And then, of course, we have a second step, which is making sure that that money can move from one person's account to another, and that transfer then becomes completely irreversible. So in the case of cash, these two stages happen basically simultaneously, right? As soon as I hand the cash over, as soon as I'm making that cash payment, that settlement happens basically instantly. That money belongs to the person to whom that money is given, and they can go ahead and spend it however the hell they want, right? So if I have $10 and I want to give $10 in cash to Andreas so he can go and have an afternoon tea at Timmy Hortons, I guess what they do in Toronto, to head off to Timmy Hortons, that payment is final the minute it touches his hands, right? So, that is the advantage and awesomeness of cash, that making the payment and settlement happens basically at exactly the same time. Not so obviously in the case of a bank-based transaction. So when I'm trying to make a bank-based transaction, when I want to send money through my bank to Andreas for his Timmy Hortons fix, in that case, I have to instruct my bank I'm making the payment, but it's going to take a while before that payment moves from my bank, my account is debited, and then to Andreas's bank to become final in his bank account so that he can use that money to go ahead and get his coffee, right? So that settlement process that happens at the second stage in the banking system takes a little bit of time. Now, one thing to highlight here is that the way in which banks do settlement in the US and in most other developed economies is pretty cool, because they rely heavily on the central bank to ensure that payments are settling in the bank's respective accounts. So depository institutions, banking institutions, all get an account mostly with the Fed. These accounts are called master accounts. And the Fed basically takes charge through a variety of different payment schemes to basically calculate which banks are owed what on a net basis, and then to debit and credit each of these banks' accounts using the Fed's own ability to communicate and access each of the accounts for the different banks in its system. So the Federal Reserve manages a whole host of payment schemes. The banks that have accounts with the Fed can participate in these schemes. And when I send a payment instruction, my bank's account is debited, and that instruction goes to the Fed, which then reconciles all the different payments owing to Andreas's account, and then finally settles those payments. So all of this process is managed by the Fed, is managed by the Fed's relationship with the banks through this master account that each of them has. And the Fed basically takes charge of doing this process, ensuring that it is reconciling the different debits and credits to finally settle the payments in the payment system. Does that all make sense? Does that all make sense? Awesome, right? So what we're dealing with are payment schemes managed by the Fed. Banks are part of those payment schemes because they have master accounts, and the Fed is doing settlement based on all of the instructions that it's receiving from the different banks about what they're owed and who's making payments and so forth. One teeny tiny observation here. When we're looking at non-banks, and I'm trying to make an instruction maybe to send $10 using the Cash App. Using the Cash App, I want to send $10 to Andreas on the Cash App. As long as we're all using the Cash App, that money can stay within the digital wallet, can stay within the Cash App network, and the Cash App will have the debits and credits that Andreas and I are owing to each other. So what we have within the sort of closed loop of the Cash App network, we have a ongoing balance within the network as to what each of us is owed. But if Andreas wants to take his money off of the Cash App, he then has to tell the Cash App he wants to do that. The Cash App will then debit its own bank account, send an instruction to its bank, and then its bank will send an instruction to Andreas's bank to credit his bank with $10. In other words, non-banks have to go through the banking system in order to settle their payments, right? That we have to progress through the banking system because money settlement in the US and in most other jurisdictions happens using the central bank provided network of payments. And in the US, this means that non-banks, even if they are gigantic payment services providers, have to progress through the banking system in order to finally settle the banking payments. So, what this means essentially, and this is a function of the banking structure today. What this means fundamentally is that we're dealing with a very closed system for payment settlement, right? This is a settlement system that is open only to the banks, right? The banks are the major gatekeepers here because they are the only cats allowed to have a master account with the Fed, right? And because the Fed is the key actor here in ensuring that money is moving from one bank account to the other bank account through all these different payment schemes, right? That the banks are the major intermediaries for settling all of the payments digitally that are moving within our economy. So when we're going through the banking system, when we're using non-banks, any settlement that takes place will have to move through this very closed system that is intermediated by the banks and by the Fed's different payment schemes. Does that make sense so far? Does that make sense? Abdullah, I think I see a raised hand on the Zoom screen.
Well, there's a very quick question that Abdullah has, which was, why do banks not settle overnight? Why is there a delay?
That's because of the payment schemes in which they're a part of. So the Fed administers a variety of different payment schemes. These include the automated clearinghouse scheme, which is the one in the US that processes most of our salary payments, for example, most of the bills that you're using to pay your electric or whatever. In addition, there are different schemes that the Fed operates. One of them is called FedWire. That's a large value payment scheme in which settlement is taking place in real time, right? That is a real-time gross settlement scheme in which one doesn't even have to wait for overnight for payments to settle. It happens instantly as soon as the money moves. So it really depends on which scheme you are at and which scheme you're using to determine the rules of that scheme and how long it takes for payments to be processed and settle in real time or with some kind of lag, as we'll discuss shortly.
Excellent, thank you. So just very briefly to the audience, I see another hand up. Unless this requires immediate clarification, I would rather have the Q&A after the session, after the presentation. Thank you.
Awesome. Okay, thank you so much. So that is the basic structure here, that we have a pretty closed loop system where banks are the ones that are charged with settling payments in the sort of digital payments environment. Any non-banks have to go through banks in order for payments to settle. All right, so that's the painful part done. Now we can move on to some of some of the more interesting aspects. What does this mean? What does this structure mean of having this architecture that depends so heavily on the banking system to settle payments throughout the economy? Right? What are some of the consequences of that for our payment system and how well and efficiently it can work? So there are a number of criticisms that have become pretty visible when we're analyzing how well the payment system in the US works. And TLDR, cut to the chase, get to the punchline, the payment system in the US basically sucks for a number of different reasons, right? It is a horrifically inefficient system for a number of different reasons. But we're going to just talk through three of the main shortcomings that we're seeing repeatedly burden and bring down and diminish the workings and efficiency of this payments environment. First and foremost, right, this is a system that is well known as being pretty under-inclusive, right? What that means is that it's not covering the population as a whole, and it certainly doesn't encompass in many ways some of the neediest within the economy. Right, so fundamentally, as we saw, banks are needed for the payments to be settled, and banks are needed to make maximum use of the payment system as a result. And this is hard then for those in the US that can't have access or don't have access to a bank account. And it turns out that in the US, there is a real financial inclusion problem historically, where large segments of the population do not have access to a usable, cheap, and easily accessible payments account, banking account. So, for example, 4.5% of US households are unbanked. This means that nobody in the household has a bank account. 14% approximately of the US is underbanked. This means that someone has a bank account, but many in the household are also using alternative payment services. For example, pawnbrokers, check cashing services, and so forth. Expensive services that are provided to those who are not necessarily having recourse to a traditional bank account. So there is an underbanking and an unbanking problem in the US. And of course, this concentrates most heavily amongst certain segments and demographics within the population, notably communities of color, lower income households, single parents, households with disabilities. So for example, approximately 19%, I believe, of Black Americans are, 11% of Black Americans are unbanked. 16% of American households with disabilities are unbanked. Single parents, about approximately 15 to 16%. Unbanked, right? So we see a greater concentration of unbanking and underbanking among certain segments of the population. So there is an inclusion problem that we're seeing and experiencing within the US payment system. Okay, even for those that have access to the fullest, banking services possible, the system is woefully inefficient, right? This is a system that sucks at many metrics of efficiency. First and foremost, in many consumer-facing, retail-facing payment schemes, payments take an inordinate amount of time to settle, right? When we're sending payments using the ACH network, which is used for processing our salary payments, bill payments, etc., payments take at least 1 business day in order to clear and settle, right? If not alternatively much longer. For those who are using checks, there are still people using checks a great deal in the US. Checks take approximately 1 to 2 business days to settle. That is obviously on a good day. Sometimes it can take as much as 5 days to settle, right? So these retail-facing payment schemes result in money moving extremely slowly from one person's account to the other, which means that money that Andreas is owed doesn't get to his account for at least 1 or 2 business days, during which he cannot use that money to go ahead and get his caffeine fix, right? So this is a massive inefficiency problem where money is trapped within the payment system. It does not get to land in the account of those who are owed that money. And as a result, the money is not being used in the most efficient and optimal way possible. Instead, it is lingering and lagging within the payment system as a whole. Right, so this is a marketplace in which payments are taking at least a day or more to clear. If we look at checks, for example, I believe there are approximately like $50 billion worth of checks being processed on any given day. That is basically $50 billion worth of value just trapped in the payment settlement process. Right, so we're dealing with a system that is horribly inefficient, incredibly slow, and this hits certain kinds of demographics and people incredibly hard. So, for example, small businesses that have tight levels of working capital have to plan their liquidity needs well in advance to be able to deal with the 1 or 2 business days of lag that they need in order to send or receive payments. Right, so that is a major cost in small businesses with tight levels of working capital. Those folks who are in the gig economy, for example, who need liquidity to pay for petrol, for example, if they're driving Ubers or Instacart, right, they need to be able to plan for the fact they may not get payments from the Uber app for 1 or 2 business days after they take that money and it lands in their bank account. Right, so there is a cost, a systematic economy-wide cost to this inefficiency arising on account of the fact that many of these settlement processes work incredibly slowly, particularly in this modern and digital economy. Third of all, the US payment system, the US dollar payment system is incredibly uncompetitive. We can, talk through this in the Q&A, certainly. The US is lagging well behind its peers. If we go around the room and focus on other countries, some of this stuff is going to be just incredibly weird to many of you who are listening to this, that it takes such a long time for payments to be made in the US. For many countries, for example, Brazil, India, the UK, Sweden, and others, payments are moving much faster. So the US is lagging behind some of its competitors in the structure of its payments environment. And perhaps sort of most importantly and kind of, weirdly, the US dollar payment system, which is, of course, the one that is needed to be able to use the US dollar as a reserve currency in international trade, this is a payment system that really is just horribly out of date, right? This is a payment system that takes incredibly long amounts of time for money to move from one country to the other. If you're making a wire transfer from the US, it can cost you as much as sort of $15 to $25 per wire transfer, including money that you have to pay to receive wire transfers. For folks who are sending money abroad, workers who are sending money abroad, for example, the average cost can be as much as $12 per transaction, right? These are processes that are slow, that are incredibly expensive, right? That are a systematic cost for businesses and people that are constantly moving money from one country to another using US dollars. So, there are some major deficiencies within the US payments environment, looking at, the under-inclusion problem, looking at inefficiencies, as well as the fact that the US is becoming an increasingly uncompetitive and lagging marketplace when looked at relative to its peers, as well as thinking through the US dollar payment system that is slow and extremely expensive. All clear so far? Everyone good so far? Everyone hanging in there? Feel free to go to the SBF trial, but we're gonna start talking about things that are very kind of relevant to us. These are areas, of course, that all of us have spent a lot of time researching, looking at stablecoins and CBDCs. And the question here is thinking about what is the particular contribution that stablecoins and CBDCs can make to addressing some of these shortcomings that are emerging within the US payments environment. What are some of the core features, the core interesting specific features of stablecoins and CBDCs in particular that make them especially good potentially, right, at addressing some of the shortcomings that we are seeing endemic within the US payment system? So, for those of us who are potentially new to stablecoins and CBDCs, just a very quick primer on how these two things are working. So, stablecoins are private money, right? This is a private issued money claim. However, unlike the traditional private money claims within our sort of mainstream payments environment, stablecoins are transferring money with an open settlement system, right? This is a settlement that is working on public blockchains that are open access, open source, Ethereum, for example. And so the stablecoins, these tokenized entitlements, are transacting and moving value on open blockchains, right? This is obviously to contrast with that closed settlement system that is used to move private money in our banking-based settlement system, in our traditional banking-based settlement system. Stablecoins, by contrast, are private money that are transacting and settling on public and open blockchains. Importantly, of course, these things are completely cross-border, as we all know, right? There's just no recognition of borders within the stablecoin, and generally the public blockchains like Ethereum and others that are allowing money and transfers to happen within these blockchains. And so what has happened, of course, is that these open access, open network blockchains are transferring these tokenized entitlements extremely quickly, usually cross-border, and at a fraction of the cost than what payment services providers pay in the traditional economy in the form of fees for wire transfers or interchange fees to move money from one person's account to the other. Right? So the stablecoin proposition is a tokenized private money that is running on open settlement system that is completely cross-border and increasingly looks like it is working in a more cost-effective way to transfer money from one individual to the next. CBDCs, by contrast, are not private money, they're public money, right? This is a publicly backed money, a digital publicly backed money claim that is owed by that sits against the balance sheet of the state. Now, this is the only form in which we the plebs get to have a digital public money claim using the CBDC. So the CBDC, its innovation, right? Its particular appeal legally is that this is public money, right? Unlike, as we move further and further away from physical cash, CBDCs are looking to step in its place by providing a digital form of public money. Now, the interesting aspects about CBDCs are also that as a digital entitlement, it is potentially able to be programmed, right? So CBDCs can potentially be programmable. This means that they can be programmed inbuilt natively with certain kinds of functionalities. For example, they may only be usable by certain segments of the population. So for example, if you want to pay for welfare, social security, etc., using CBDCs, that CBDC might only be usable by someone who is owed that money, someone who is entitled to the social security or the welfare payment. So the CBDC can be programmed in ways that allows it to be used in certain, pretty sophisticated, interesting ways. Of course, we can't do any of that using even the online banking system. We don't have programmability in that system. And so what we're doing here is creating a potentially sophisticated smart token that is public money, programmable, and can enable the state to exercise a range of monetary functions as a result. And we can kind of talk through some of the ideas behind that. The settlement infrastructure for CBDCs is not yet decided. So even though we have a lot of experimentation going on around the world with CBDCs, there's no big consensus on what the settlement system here is likely to be. Most likely, this is going to be an entirely new settlement infrastructure. So we're not going to go back to the traditional bank-based settlement rails that we're used to having traditionally today. This is going to be an entirely new system, an entirely new payment rail that the central bank is looking to set up. In many cases, this is not going to be on a blockchain. It's going to be centrally managed by the central bank itself. And so this is a brand new payments architecture whose design is still up for grabs. It doesn't have to be on a blockchain, and if it is, it's going to be on a permission blockchain. Open source public blockchains are generally regarded as a pretty big no-no within the CBDC context. So, finally, in contrast to stablecoins, CBDCs, as you can imagine, are more domestic in nature. We have, approximately 100 countries or more currently experimenting with the prospect of CBDCs. Each of them has their own specific design that they're coming to the marketplace with. So those are the two, big contrasts between stables and CBDCs. Stables is private money on an open source, open settlement network. CBDCs are public money digital claims that are programmable and potentially running on an entirely new payments rail. So what are some of the use cases that we might apply stablecoins and CBDCs to that might work to improve and enhance the current deficiencies within our payment system? So first and foremost is the financial stability angle when we're thinking through CBDCs. Now, as all of us can kind of get that the inclusion of a very large number of private money claims can potentially create stability risks for the economy as a whole. So, for example, when most of our money claims, over 90% of our money claims are owed as private money claims, then we have a potential stability risk where the banking system, for example, or major non-banks fall into a distressed situation or are potentially heading towards failure. That can lead to the risk that those of us who are owed money, those of us who are expecting to be easily able to use that money, suddenly find ourselves unable to do so. Right? So there's a big stability risk here that the CBDC is putting itself forward as a solution looking to solve that problem. So the case for CBDCs as a stability boosting tool, right? That case is being made most loudly by Sweden, for example, right? In Sweden, it's a very, very digitized payments economy, hardly any use of cash. Within Sweden, folks are using Swisha and other, digital payment mechanisms. And so the government in Sweden, the central bank, the Sveriges Bank, is extremely worried about the stability implications. And so the CBDC, the e-krona that is being piloted in Sweden, is designed with the specific purpose of increasing stability within the payments infrastructure there by increasing the amount of public claims, public payment claims within the economy as a way to balance this out with the prevalence of private claims in payments in Sweden. In addition to Sweden, the UK, Japan, and others are pushing CBDCs potentially as stability boosting diversification strategies within the payments economy. In addition, obviously, with the CBDCs, these are state-backed claims. They should be cheap to issue and manage, right? The state is playing a big role in issuing and managing these claims, which means that private providers that are willing to distribute them can do so at low cost. So the idea here is that CBDC payment schemes, for example, could be used to attract folks who are unable to access the banking system, for example, at very low cost, to be able to encourage, greater uptake and financial inclusion, entry within the formal economy, benefits for taxation, for example. And so having CBDCs do that is something that can happen because these carry zero credit risk. So there's no need for federal insurance. They come insured as a matter of course. So CBDCs as an inclusion tool, for example, is a solution that is being thought about, for example, in the case of the Bahamas, where the sand dollar, the Bahamian CBDC, is being issued, a sand dollar account is being issued to everyone in the country for $500 balances, don't need any kind of documentation. This is an account that is open basically to everyone as a means of creating a state-backed inclusion-focused payment solution. Finally, the fact of having programmability, and I'll try and be quick here, the fact of having programmability means that we're able to use money in a much more creative way. So, for example, we can think about ways in which the CBDC might extinguish itself after a period of time, 6 months, a year. That might encourage folks to spend that money quickly in the economy. That might be useful when we're thinking about stimulus payments, for example, as happened in the case of COVID, that we're trying to do things that encourage spending. And so the CBDC might be able to be programmed to extinguish itself. We could have CBDC accounts for kids, which means they can't, use the CBDC for pay for stuff they want to buy off of TikTok. They can't use it for vapes or alcohol or whatever. Program the CBDC so it's only usable in certain contexts and by certain people. Right, so there's a lot of thinking that is going on here about programmability and the potential for giving policymakers a range of tools about how they manage the economy. Now, very quickly, in the case of stablecoins, right, the major use case that is emerging here is in the case of international payments. Right, the ability to use this kind of more open open payment solution that is coming with low fees, international, built-in public blockchains, that one can have US dollar payments that are settling far faster in the case of the stablecoin network than they would using the traditional banking network to move US dollars from one country to the other. Right, so stablecoins are really being put forward as a tool for international payments. And some of the use cases that have emerged here, for example, have involved, folks in, potentially more unstable banking environments, buying US dollar stablecoins as a way to hedge against the inflation in their own country, to basically buy US dollar stablecoins and make them extremely transferable, owing to their ability to be transferred across these very international settlement networks. So, that is the kind of use cases that are emerging for stablecoins and CBDCs. And so in about 5 minutes, I'm going to quickly talk about some of the regulatory issues here. So the major question for stablecoins as private money is really, how risky are they? How risky are the stablecoins issuers that are coming into the economy, promising these highly tokenized, super, fast, cheap, and efficient payment systems, but that are run on a very open settlement network? But what are some of the risks that are being posed here? So the key question is, how do we safeguard the payments issuers here who are looking to provide stablecoins within the economy on a large scale? How do we ensure that they have the assets to back up the stablecoin claims that they're issuing? And importantly, where are these assets kept? Now, for example, if one is dealing in cash, a stablecoin issuer that maintains a cash account with a bank, right? The danger here is, of course, that the bank might be doing fractional reserve banking with that cash, so that when the stablecoin issuer needs that cash back, that cash may actually have been lent out throughout the banking system and may not be available immediately to the stablecoin issuer. right? This is something that happened, for example, in March 2020, when Silicon Valley Bank failed and Circle, the major stablecoin issuer, had $3 billion worth of deposits with SVB, meaning, of course, it was a pretty hairy, horrible weekend for the folks at Circle. Right, so thinking through, whether these assets exist, what kind of transparency exists for us to vet these assets, how they're held, should they be held in a master account with the Fed, for example? These are all major regulatory questions that are emerging in the context of stablecoins and how they ought to be regulated. Thinking through redemption rights, right? Stablecoins, according to a survey by Gary Gorton and Jeff Sang, right, come with a variety of different redemption rights attached to them. What does this mean for potential run risk, where holders may not be able to get their money out straight away and as they might expect, because the redemption rights in this context vary quite considerably depending on the coin that folks are using. In the context of CBDCs, of course, there's some major design issues that are being debated. First and foremost, of course, is the issue of how CBDCs ought to exist within a diverse and private-orientated banking system. In other words, what is the stability risk that CBDCs pose for the banking system as a whole? The big danger here, of course, is that folks want to have state-backed banking claims and don't want to have to deal with the private market where the banking may be subject to credit risk. So in the event that there's a potential bank failure, Silicon Valley Bank, for example, folks may try and immediately convert their banking claims into CBDC claims. Right, and so that is a danger of depositor and capital flight from the banking system in the context where it is least needed and that bank is closest to default. Right, so we're dealing with these stability issues that are a key reflection of the fact that we're thinking through some of the design ideas about how to ensure that we can keep our banking system insulated from any risks posed to stability by the CBDC introduction within the economy. In addition, of course, there are big questions today about how to deal with governance aspects of CBDCs. I think all of us here probably don't want to be surveilled by the state, right? We don't necessarily want our spending controlled by the state. We don't want to be tracked by the state. So the question, of course, is how do we regulate CBDCs so that we're able to maintain some kind of privacy, some kind of data integrity and control over our own payments data, right? To ensure that there is user uptake, network effects, and folks are feeling safe and comfortable using that CBDC technology, right? So there are questions surrounding the power of the state, questions surrounding the state's ability to access and use data, and for the state to then be able to police us as it's collecting payments data through our own use processes, right? So those are some of the key questions that are coming out in the context of the CBDC. So, by and large, there are, some, there's some major, question marks here surrounding the question of how these things ought to be regulated, some of the policy questions. Great news, there are no answers, which means that folks in this group have a lot of space in which to do their research and get their papers out to talk through and think about some of these questions that are emerging. So with that, I think we have about 20-25 minutes for questions, Andreas. So
yeah, we do. So thank you so much. Thank you so much, Yesha. That was a great presentation. Was very engaging. So we have a lot of questions in the chat, and from those questions, I can already see that we could probably easily fill another 45 minutes or so with those, which we won't. But let me start with a few observations and general questions then, so to start the conversation. So I want to talk about food trucks for a moment.
Okay.
And as follows. So the city of Toronto is maybe about 10, 15 years ago, there was this huge movement in the US in particular, coming from LA, with food trucks, and people in Canada got very excited about too, and they wanted food trucks in Toronto. And the city of Toronto wouldn't have any of it. And eventually they came up with the idea and said, we're going to have well-regulated food trucks, which it's just a perfect arrangement, which is safe and which people want. So they came up with the design for the food truck, up to the, exactly determining what people can and cannot do, what food can and cannot be served, what information has to be provided. About 12 people decided to take the plunge. They spend a lot of money buying this particular trucks to specification, and I don't think any of them survived for more than a year. meaning that essentially there was a food truck was designed which worked for the government, had all the specification that they think that people needed, and it was neither sufficient for businesses nor for the consumer. Now, I'm bringing this up because I think there's a very important lesson to be learned here for not just for the government itself, but actually also for us as economists, lawyers, and so on, which is that we have absolutely no clue, to be honest, how actually people will want to use a CBDC or any kind of money, and what actually would work for people, what they want to have.
Yeah.
Now, I don't want to say that business is all knowing and so on, but the market is all knowing and knows what they want. And so I'm actually really rather worried when it comes to CBDCs that we come up with a monster that we create that, basically has no market. And I think that's, usually the problem that occurs with anything that is government designed. Governments may get it right, but more likely than not, when too many people try to do something, it gets badly wrong. Now, I'm bringing this up because I want to talk more and zoom in on a particular item, which actually Larry Wall, who's from the Fed, also raised in one of his question, which is AML protection. And so AML is, and also I think Thomas mentioned that too. No, Josh White mentioned it. So one of the concerns that you mentioned at various points is the question of privacy and money laundering regulations, and so on and so forth. As you know, this is something which goes back actually quite a while. I think the first money regulation was in 1970, which is also when the $10,000 limit came into being, which would be $80,000 today. Actually, if we would apply $80,000, I think many problems would actually be much smaller. But so the concern here is, and so this brings, so let me just put this very, very briefly and have a very specific question. So one of the early challenges to the money laundering regulations was that of the Fourth Amendment in the US. So the search and seizure, where the Supreme Court ruled because somebody used a bank, they've already made a disclosure to a third party, and so therefore the Fourth Amendment right doesn't apply. And that essentially, if you aggregate this out, anytime we have anything other than a peer-to-peer transaction, if we have a broker in between, we will have possibly constant surveillance and monitoring by government. And it is, for me, it's very hard to see how we can have a CBDC that is compliant with current money laundering regulation that does not involve constant monitoring. So how do you see that problem can actually be resolved?
Yeah, so incredible insights, and thank you so much to Larry, Josh, and others for contributing to these insights. So the question about money laundering is extremely critical here. Money laundering regs are, as you mentioned, Andreas, right, absolutely critical to the fundamental design of the payment system broadly, particularly in the banking system. So the money laundering regs have come up as being particularly problematic in the context of stablecoins, right? That anyone is able to open a wallet pseudonymously on the public block, on various public blockchains, and therefore being able to comply with money laundering regs is that much harder within this sort of overarchingly decentralized settlement system. So certainly in the case of stablecoins, one of the major issues is coming up in the context of regulation in the private market solution is this compliance issue with AML money laundering. And it raises a larger question that I think you're trying to get to, Andreas, which is, do we need to rethink how we do money laundering regs, right? In other words, is there a deeper question about how we redo money laundering regs? There's some proposals out there that would require market participants and bank services providers to do record keeping rather than constant monitoring, for example, tweaks to the money laundering regulation application that could potentially result in allowing for potentially greater compliance by digital asset issuers with applicable money laundering regs. So, these are real concerns. In the context of the CBDC, it's a deeply contentious question. So what you raised is regarding state surveillance. Obviously, the big user currently of CBDC, the biggest pilot is underway in China. Approximately 120 million, I believe, folks have been included within that pilot. And so the big concerns, at least, looking at that model, is with respect to state surveillance. So the Chinese authorities have taken a particular approach to dealing with the potential for worries about surveillance using the CBDC tool, which is to provide a general account-based CBDC, in other words, where you, Andreas, are identifiable from Josh, for example, versus a token-based CBDC, right? Which would be basically like a card that is less identifiable to the person specifically. And so a token-based CBDC could be used for smaller payments as a way to potentially use that card for payments that are unlikely to pose a large risk to the larger financial system through money laundering. That is the so-called compromise that's being reached in the case of the Chinese issue. However, I think for most CBDC design, even using a token-based solution, folks are still pretty convinced that some element of self-identification will be required. Intelligent chips could certainly enable things like geolocation to be attached to that identification. And that, the fact that we do need to be mindful of money laundering regs as they currently exist would mean that having a completely anonymous cash-like token is unlikely to be the future of even a token-based CBDC. So while there are design optionalities being trialed, for example, a token-based CBDC, I'm not sure how many people necessarily buy the fact that that's going to be fully anonymous, as cash more than likely tends to be in the payments economy today.
Yeah, so I think there's a lot of questions that actually interacting here, right? So the question about programmability actually goes in the same direction,
right?
Which is that it sounds like something that's really cool to do, but on the other hand, this actually could be something which is very scary, right? Because you can have expiring money that you're not aware of, and so on. There's a lot of little details that could come out there. Now, I will say it is actually possible to have strong privacy protections and design a CBDC this way. We've thought about this. I've thought about this with some co-authors on that one.
Mm-hmm.
The question is really one of a political will, right? If you actually want to do it that way, right? Because that would mean that you actually, you give up possibly some tools which the government would like to have, like understanding where money flows and so on. Now, I want to go through some of the questions here also that we have. So there were several questions. So Thomas Rivera has a question, and also Larry has a question, which goes at the discussion about the FedNow system, essentially. So the real-time payments that we have. So one of the things that is interesting to observe in the US is there is the FedNow system, which actually makes payments potentially much faster. And I'm wondering if you have any comments on that in terms of the usage and whether or not this actually is effective at this stage.
So with apologies to Larry, and the FedNow system, I have a pretty bleak view on, unfortunately. This is a brand new real-time payment system that has been brought online by the Fed. It's a wonderful thing to try and do to kind of bring that payment system in line with international counterparts that are providing real-time payments. But there's some real issues with the FedNow design. First and foremost, as currently designed, it is a bank-only system, which means it doesn't deal with those folks that don't necessarily have a bank account, right? So this is a bank-based system, open only to the banks at present. And importantly, it is a bank-based system that requires currently that folks are only able to receive payments. So the banks that are coming online don't necessarily have to be able to make payments, but they certainly have to be able to receive payments if they join that FedNow scheme. Certainly a lot of banks are, cool with just, having the infrastructure to receive payments. Those that are signing up to make payments is, again, something that has to, be seen, but it doesn't look like there's, that discrepancy certainly exists at present. The second problem with FedNow is that the number of banks signing up to FedNow remains pretty small. In particular, this is a scheme that has not reached and has not encouraged uptake or has not gained uptake so far, early days certainly, from the large network of community banks and regional banks within the US. So these kind of faraway banks in, potentially South Dakota, Nebraska, all these, smaller community banks, they're not signing up en masse to join FedNow. So again, that limits the network effects of this payment scheme. Thirdly, this is a scheme that isn't competing with a bank offered payments scheme in real time. Real-time payments is another competing real-time payment scheme in the US. It is run by a consortium of some of the biggest banks, including obviously the big names like Bank of America, Citigroup, JP Morgan, others. They're running that real-time payment scheme. And so we actually haven't even seen some of the larger banks want to join FedNow. I'm with Bank of America. I don't think Bank of America has joined FedNow, so I can't make payments using FedNow. So again, that is a major hindrance on its network effects. Fourth of all, FedNow and real-time payments are not interoperable, which means that if a bank is in FedNow but not in real-time payments, they can't communicate with one another in the scheme. And then finally, FedNow, I believe, has money. Banks can set the fees for making payments. In many different countries like India, which has UPI, Brazil, which has Pix, UK that has faster payments, Sweden that has Swish, payments are made free of charge. So real-time retail payments are subsidized by the state. And so they have captured a lot of network effects as a result of that. FedNow, there is a cost that is determined by individual banks. And so that is potentially another break on network update, reducing the ability of FedNow to spread the gospel of real-time payments across the US as a whole.
So now another question, which I'm just paraphrasing and summarizing some of the points that were raised, is as you say, right? So stablecoins and CBDCs are not mutually exclusive, right? And in particular, actually, you could even imagine a situation where a CBDC or a government actually issues a portion of actually issues its own stablecoin, if you want, right? It's actually something that's technologically easily feasible. It's a question of whether they want to do it, of course. So if you just think of the market sizes, given the description that you made, can you give us a sense of what portion of a market, say for the US in particular, would be covered by something like a CBDC, given the constraints that we see, and then what would be stable coins, smaller, larger, orders of magnitude, smaller, larger? What do you think?
Yeah, I mean, it's a really interesting question. I think it's one that different banking authorities are wrestling with. In other words, what proportion is okay to have in CBDC issued claims? Couple of thoughts on that. Firstly, banks are not super keen on CBDCs, retail CBDCs. So they don't want a huge proportion of money claims issued in CBDCs because they're worried about the stability risk of their own potential, institution. However, banks are pretty keen on wholesale CBDCs. These are CBDCs that might be used as a settlement asset between them that is potentially programmable to read information in real time and adjust balances accordingly. So they're super keen on CBDC issuance that would relate to wholesale use only and potentially allow for a greater, efficiency within the settlement environment. So, that is, two considerations here as to what proportion might exist here. And, one of the challenges that policymakers are confronting is that no one really knows what the right balance between public and private money claims is. So, 2010 in the UK, for example, 60% of payments are in public money. Today, that figure is, far, far lower. In Sweden, it's like, extremely negligible. And so no one knows exactly what the right balance is. And ultimately, some of that balance will go to the larger stability of the private banking and commercial payments environment. How safe are these institutions? If too many private claims are within these institutions and they're not safe, and the state doesn't have the capacity to rescue and protect them, then in that case, there's just too many private claims in the market and far fewer public claims than they should be. And so that is a larger question that goes to the stability and architecture of the payments environment, banking environment. And that's a super hard question to solve. So we need one of your papers on that, Andreas, I think,
Don't put this on me.
try and answer it.
So now I have another question here, which is also related to this, which is as follows. So now imagine a world in which actually, blockchains actually do take over in the form of that financial institutions, for instance, issue existing assets. So it's not just the crypto bros that are operating in this world. In my opinion, what will probably be necessary is that there would be actually a lot of money available so that you can actually facilitate all the transactions that would have to occur. Now, the concern that should arise, and I have not seen much work on that or much talk about that, is if you have a stable coin, you take it very seriously, and it's not a bank deposit as we currently have it that has no deposit insurance, where, essentially you had Circle give Silicon Valley Bank, $5 billion worth of money, which was sitting on a bank account. That's not a good idea to do in the first place, right? And I think as a result, what happened is Circle almost entirely switched to repos. Now, repos, if you basically have fully financed by repos, this is like an inch away from being a narrow bank, which the Fed really hates, right?
Yeah.
And then if we had actually a massive tokenization where we take corporate bonds and derivatives and stocks and all have them available on blockchains, we probably need orders of magnitude more in stable coins, which would mean we would literally create a narrow bank.
Yeah.
And all of that money, so the problem that I see with this is the narrow bank money, so the money that is in stable coins is actually not in the banking system, which means that monetary policy transmission channels don't work anymore.
Right.
And the like, right? So this is something which I don't think we're yet prepared to do. So is that something that is even, I mean, you're in the Atlantic Council and so on, is that something that's actually being discussed?
Absolutely being discussed. So this is part of the larger regulatory permission structure to be, to be decided with respect to stablecoin issuers. There's two major questions here. One, who gets to issue stablecoins? So in the US, for example, there's a big debate between whether only banks can issue stablecoins, in which you keep it within the banking system. And potentially, as a result of that, if banks are doing it, then they are more easily controllable from the monetary stability and financial standpoint, closer to the Fed, for example. If only banks do it, then potentially some of these concerns surrounding transmission of monetary policy can be eased if the accounts are holding assets in a way that could potentially, allow for fractional reserve banking because banks are keeping capital buffers and so forth. On the other hand, the larger question that Federal Reserve and federal officials are increasingly open to is also allowing non-banks to issue stablecoins. And in that context, there is a debate surrounding whether or not non-banks, for example, should only be able to issue stablecoins as narrow banks. In other words, they are not able to do any kind of lending with the assets that they're holding. There's no fractional reserve banking that can happen. Certainly that would limit money creation as a whole, with the assets that are being held. And so the compromise potentially that's being discussed is, if banks are issuing stable coins, there might be one regime potentially. I mean, it's not clear yet. Non-banks may be likely to only issue stable coins as narrow banks, reflecting the fact that they're not subject to banking regs and banking requirements. Now, there's certain jurisdictions in the world, for example, India, that have had non-banks, for example, be given narrow banking payments licenses. And so what they're doing is providing vast amounts of payment services, but essentially structuring their operations entirely as narrow banks. They can't issue credit cards, for example. They can't do lending. And so this is a model that's been used for general normal payments, right, to not allow money creation through the non-bank sector. But this leads in the stablecoin context to the bigger question: who gets to issue stablecoins and what regulatory regime are they subject to? And that may influence what kind of banking or narrow banking they can provide with the assets that they hold.
Now, I want to be mindful of time, but I want to squeeze in one more question where, again, I'm paraphrasing and combining some of the points, then in this case, that Katrin Tin made from McGill, and then also Joe Polito. And this is about the power of banks and the interests of banks that they actually have in this context. So payments is very, very profitable for financial institutions.
Right.
The numbers you hear about the profitability of the payment sector itself is on the order of returns on equity in excess of 20-30%. So that's nice, right? Nice money to have. And that's, in some sense, they would have to give some of them up. You have the European Union has restrictions on the holdings that you can have. There's usually the argument that, we don't want to have a bank run of some kind. But in many ways, this is also a question of perpetuating just the market power in the payment sector that financial institutions as such have. So what are your views on this discussion? To what extent do some of the discussions that we have on stability are genuine about, real concerns about the banking sector, or are more about the ability for banks to keep their profits line open?
Yeah, I mean, there's definitely that concern, which is that the settlement mechanisms within the current payments environment, deeply bank focused. The traditional justification, of course, is that banks are stability buffers for the payment system. They're super regulated. So obviously they're the ones that get access into the payment settlement system. But clearly there's a huge amount of pressure coming from non-banks. There's a huge amount of pressure coming from those that have entered the fintech economy that want to be able to settle directly. So, one of the major challenges that's coming up today, there's a court case on it too, is who gets to have a master account. In other words, who gets to have an account with the Fed, who gets to enter these payment schemes. And ultimately, that question is going to the larger political economy of, banks potentially losing their franchise as the gatekeepers into the payment settlement system. So that would certainly erode potentially bank fees that they are earning because they're providing the settlement services for payments. So for example, if you want to take money off of a peer-to-peer app, you want to put it into the payments account straight away, you have to pay, you know, $15 or whatever to, you know, to do that. That costs a fee. That fee is for JP Morgan or someone to use real-time payments in order for that money to go instantly through the banking system. So certainly there is this larger political economy that's at play here. And so this is probably why these debates are becoming extremely contentious.
Well, thank you so much. We are now over time already.
Oh dear.
Yesha, thank you so much for a great presentation and discussion. I hope that in the process here, I have represented everybody's question to the best of my abilities. I think maybe some of them, some of the audience members may want to email you directly if you're
Absolutely.
open to that.
Everyone's free to email. And I just want to thank you so much for your time. I want to thank you so much, Andreas. I want to thank you so much for joining this webinar. I know you have a lot of demands on your time, so thank you so much, and always welcome your feedback and your questions.
Well, thank you so much, Yesha.